Well, good afternoon, investors, and welcome to the mid-March pre-St. Patrick's Day edition of Bull Sessions. My name is Mark Robertson. I'm joined here by my dear raconteur colleague, Ken Kavula, doubling in the role as Mr. Potter there on the upper left this afternoon. Good afternoon, Ken.
Good afternoon, Mark. That's where you pulled that from. Okay, now that you say it, I recognize it. Yeah.
Somehow, I think that is the least correlated connection between two people I've ever known. So, hopefully, you don't hate me for it. And of course, that's George Bailey on the right during a bank run. And we can't have a session today without talking a little bit about bank runs and how ugly they are and preventing them. And in honor of that, we actually have a special guest, Matt Spielman. Good afternoon, Matt.
Good afternoon.
Matt has been posting, along with another one of our backroom guests, Len Douglas, a number of things about the situations going on at Silvergate's Signature Bank and last but not least, Silicon Valley Bank. So welcome to
last and least.
Last and least. Good afternoon, Len.
Good afternoon, all.
And do you have a yellow orb in your sky down on the south side of Detroit?
Actually, we got it looks like a spring day, bright and sunny.
It's a trap.
We had snow overnight, but let's see what the outside temperature is 31, so we still have snow outside.
Yep. Still working the snow belt up here. And then we have one very, very special attendee here today, Meredith. Ross is a retired bank examiner, longtime friend of our community and investor. He operates out of Salt Lake City, Utah, and he's hung out at a few banks in his day. Good afternoon, Ross.
Afternoon. Makes me uncomfortable to be so special, but I'm glad to be here.
Well, we're awfully glad that you are here. You know, part of our topic today is going to be March Madness, and that all ties in pretty carefully with what's been going on with Silicon Valley Bank and a few others. We're probably going to defer the international stuff because there's actually some connections here. Some of the stuff that's happening in the domestic banks, you actually pick up on some of that when you start charting out some of the valuations all around the globe. And I wanted to take a closer look at that, along with a number of global and international funds that have trickled to the top of our fund database. So we will take a look at that. And we are going to do a little bit more with Planet of the Apes, just kind of nailing down that long-term winning streak for stocks. And other than that, happy St. Patrick's Day to all of you out there. Any special plans for St. Patrick's Day coming up?
My
I'm
son
gonna
is
hide.
born on St. Patrick's Day.
Oh, well, that's a good one. That's a real good one.
Always special, yeah. he thinks he has the best birthday parties, particularly in our years in Ireland.
I'm going to hide in the corner and hope nobody else goes to the hospital. It's as simple as that.
I don't think going to my podiatrist on St. Patty's Day counts. So.
Podiatrist does not count, no. All right, and of course, we can't leave this slide without acknowledging Donna Reed handing out her honeymoon money to stave off a bank run. Now, Ross, you've never had to actually go into that mode, have you?
No, not that mode. I've been on the other end of a bank run where I've been trying to console the bankers.
Ah, yes. All right, let's go ahead and get underway, guys. Here's our standard disclaimer, standing orders. No investment recommendation is intended. This is about education, specifically the demonstration of principles, methods, techniques, analysis methods, portfolio design and management techniques, all championed by the Modern Investment Club movement. So you're going to hear our opinions of how to interpret them and deploy them. And there's a whole bunch of people here that have been investing for multiple decades and having a pretty good time doing it. If we own something that we talk about in our portfolios, our personal portfolios, we'll try to remember to disclose that. We do a monthly webcast known as the Roundtable that we've been doing for about 13 years by the way, the rate of return on that tracking portfolio has now edged back above 16% per year. So it's kind of fun to watch along on the tracking portfolio. Every month we present 4 or 5 ideas from some fairly seasoned investors, basically walking through the discovery and analysis of an opportunity. So that's what we do there. If you'd like to be added to a reminder list about those monthly sessions, send an email to nkavula1@comcast.net. If you have any questions to follow up to today's session, or if you'd like copies of slides, our 2 email addresses are there on the slide, markr@manifestinvesting.com and kkavula1@comcast.net. Anything else you'd like to add, Ken?
No, except to say that I hope to learn a little bit about what I might have missed in evaluating Western Alliance Bank. I hope it wasn't anything that was staring me right in the face. We'll have to see if my analysis was correct in the long term, or whether there was something that really was fundamentally unsound about the practices coming from the bank. I have been doing a lot of work taking a look at that one and a couple of other banks that I like in detail. I'll be very open and honest with the fact that on Friday I did buy some more of a couple of the banks that I really like. I figure in for a penny, in for a pound, and I was able to pick up some stocks at extreme fire sale prices. We'll have to look a year down the road or 2 years down the road to see if I was wise in that, or if I was doing the same thing I did as an early investor in putting more money into Pan American Airlines. We'll have to check that out. But I'm at the point in my investing career where I do have some mad money, and some of that mad money went to work on Friday. I'm just hoping that if for no other reason than dividend, I'm going to be pleased with the way that mad money is being put to use in the coming months.
Well, I'm sure we will cover that, along with the reality that there still are many unknowns. But Ross did an excellent post on the Manifest Forum, and both Len and Matt have been sharing all kinds of banking stuff. So yeah, we'll cover that stuff. Let's go ahead and start here. And by the way, Ken, I joined you as a shareholder at Western Alliance, but only for a few hours yesterday. More on that.
You were in and out, huh, Mark?
I have never done that before. And
You're a day trader.
Yeah, I was going to say, now that Ardelyx isn't a penny stock, Mark needs some kind of an exciting hobby.
Mark, yeah. I thought, Mark, you bought it Friday, though, didn't you?
No, I bought it Monday and sold it before lunch.
Okay.
So I wasn't going to admit that because it really is weird, but I think it kind of fits. You know, the stuff that's going on, the turmoil and turbulence in the banking industry is spilling over into a lot of stuff. And you guys are all familiar with this chart. We know that the general average stock price follows that blue line over the long term. And Ken, you will notice that on the far right, we have dipped fairly significantly thanks to February in the first few days of March below the blue line again. And it's just a reminder that things are going to start to be on sale again more than usual. And
for purposes of disclosure, Mark, I'll let you know that one of my other purchases was in Charles Schwab. I'm a long time holder of Schwab shares, and I just felt Schwab had been punished for something that it probably shouldn't be punished for. I've been listening. In fact, I was a little bit late to the party here about 15 minutes ago because I was listening to the CEO from Schwab being interviewed on television, and he was answering some pretty tough questions with some pretty good answers as far as I was concerned. So.
And maybe we can get Matt to comment on the Western Alliance release that came out yesterday too, to see how that kind of calmed fears. But and that's kind of a segue. One of the things that worries me is Jim Cramer keeps recommending Schwab. So maybe we get more buying opportunities before.
Well, even a blind squirrel, all that kind of stuff.
We're gonna
Matt,
talk
are
about-
you going to include the upgrade that Wells Fargo gave Western Alliance this morning?
Yeah, I mean, we could spend hours getting everything.
Yeah.
There's definitely a lot of new news today, if you can believe it's moving so fast. We do
Yeah.
have a couple of the charts that we've had in the forum in the slide deck here that we can center
Yeah.
the conversation around for Western Alliance.
I was disappointed to see Western Alliance and a couple of the other names in that list from Moody's that came out yesterday. I was very disappointed to see that. So I'll have to see if Moody's has some ammunition to back up what they're going to. They didn't really tell you very much about what they wanted to investigate, but I think they had 8 banks they're going to take a close look at. So
Yeah, I saw.
Yeah, there's also,
Six.
I mean, it's not just who they said. There were also a couple of banks, and I'm running to see it, that they left out. And I think that there's a little bit of a, I don't know if it's West Coast-ism. Here, let me see. Anyway, we can talk about when we get there, but there's a couple of notable ones, including some large ones, which they left out as well. And yeah, how they chose that, if it was a knee-jerk reaction simply to uninsured deposits or something else a little deeper, will be interesting to see how that turns out.
Yeah, I would
or
agree with that.
if it was a case of just having to show the public that they were doing something.
Right.
That kind of was the impression I had when that thing first hit the wire, that it wasn't being backed up by very much other than a list of names. And that I don't like that when people make an accusation that you slap it on the wall and then you'll wait for a couple of months to tell me what the details are. So
In that spirit, when we get there, we can kind of kick that stuff around. But I will tell you, the thing that probably influenced me the most, Monday morning or Sunday evening, I guess it would have been Monday morning, I watched a podcast by Professor Scott Galloway, and Professor G, he goes by in the podcast or whatever, and he closed it. Again, he has actual dollars deposited at Silicon Valley Bank. And, he's involved in some of the startup situations out in California. And after listening to him kind of crank through some of the realities, for example, one of the things he pointed out was at his companies that he's involved in operating, they pay their employees from the cash flow. So it doesn't really matter what's happening at those bank accounts. And he says, and I'm not the only one. You keep hearing all these horror stories about what will happen with payrolls and stuff. And most of it is just kind of pouring gasoline on a fire. But then he went on to close the podcast with that statement on the upper right.
you're not accusing any of the TV commentators of doing that, are you, Mark?
I just did, I think. But up at the upper right, and I think Galloway's right about this. My experience as an investor, and perhaps we can get Ross to chime in, nothing is ever as good or as bad as it seems when you're in the moment. And that was part of the inspiration for me to buy Western Alliance Bank yesterday morning. I didn't expect to sell it, and I'll explain why I sold it, but I didn't expect to sell it so quickly. I've never done that before, but I'll put the basis together for it when we're going over that with Matt. But that saying from Scott Galloway, he's not the one who quoted it, he simply said it on this podcast. It can be incredibly true.
I think that might be a subtitle to Andy Duke's book too. I mean, the role of emotions and the lizard brain, or system one, whatever you think about it, into what should be, if not a perfect mathematical calculation, a reasoned decision is very evident in the last 3 days.
Absolutely.
Yeah, the audience is asking if I purchased First Foundation. I've never owned First Foundation. I still don't own it. It's never even been on my list of banks that I'm extremely interested in. The one that I have an extreme interest in and that I own shares of, I have not added to First Financial, FFIN. I have not added to it, but it didn't seem to have any of the same extreme ups and downs as the two that I spoke about, as Schwab and Western Alliance. If it's appropriate, I will divulge the names of the other two
Yeah.
banks that I'm taking a look at. But
It'll be appropriate.
yeah,
Later on, we're
yeah,
going to look at a series of slides that
yeah.
definitely is worth it. All right, let's take a quick time out. I'll go through this really quickly. Our Groundhog Challenge, since we were away last week, apologize for the interruption in our schedule, but I had some really serious crap to attend to. Highly technical phrase, crap.
That's
That's all you get to know. Here's our top 40. I did stretch all the way down to 44 for obvious reasons. Some pretty interesting names at the top of this list, including Matt Spielman up near the top. Ron Thorson continues up there, so does Kim. It's time for somebody to knock Einhorn off the number one spot, though. I'm tired of him being up there. And just kind of there's some really interesting names on this list, longtime community contributors. And it's just a whole lot of fun to see those new names up there. And yes, Ken, the Cowtown Investment Club made it to number 36.
all right. I've been watching a name, Mark, go from the 130s at the beginning of the contest up into the 60s now. So I'm hoping to see that name push into the 40s here at some point. So
Does it start with a K?
starts with 2 Ks. So.
All right, good
You need
stuff.
to knock off number 44.
We'll make room for you. All right. Just a real quick nod to something that we have dealt with over the years in our investment club visits, and it's just something that I have mentioned a few times. I do have fairly strong concerns about Apple's concentration and their geographic production, all that kind of stuff. I'm not here to try to call Warren Buffett or his lieutenants wrong on any of this. I'm just saying that they are incredibly exposed to Apple, and just leave it at that. If you're in an investment club or if you have a personal portfolio that reaches a 40% concentration in one stock, our general advice is you probably want to be watching for selling opportunities to do some rebalancing. And I don't think we're wrong about that.
And Mark, I want to add that the time to start thinking about that rebalance might not be at 40 or 45%. It might be when it hits 30% that you start thinking. Because it's the kind of decision that a club has a terrible time making. The discussions themselves can be infinitely long. So when you hit 33%, maybe it's time to start talking about it.
I would agree. And then there's your look at Berkshire Hathaway's book value per share. We'll be talking more about tangible book value in a few minutes. Just a reminder that we really do watch the book value and the return on equity, just as Mr. Buffett always has. And also to make the point that whatever's happening right now, it's, and I'm doing air quotes, special. The Berkshire Hathaway return on equity is negative, and you can see the times when it has spiked down towards zero in the past, including 2000, including the COVID moment, including 2008, and all the way back in the early 1990s when Iraq was a situation. So we're in something right now. All right. One other nod of the cap to another one of our groundhog leaders, Herb Lemkool, who suggested Travel Centers of America. It rhymes with Buc-ee's. And I think he suggested we take a closer look at that somewhere in the low 30s. And lo and behold, it got taken out by BP in the 80s. So tip of the cap to Herb Lemkool. We just need to listen better to Herb. All right. And one last moment, Ronnie Thorson actually posted something on Facebook about something I had forgotten about. You used to be able to buy a complete home in the Sears catalog. And I just think this is cool. Sears was IKEA before IKEA. And you got the plans for $1, I think it says down there on the lower right. And then they made sure that you were sent all the pieces that you needed along with the plans to build these houses. And Ken, I don't know if you were aware of this, but there's a bunch of these in Michigan.
Well, there's a bunch of these in Cleveland also, Mark. The
Yeah.
first 5.5 years of my life, I lived in a Sears home with my parents and my brother and my grandmother. My grandmother owned a Sears home in a neighborhood of Sears homes on the east side of Cleveland. It was a home very similar to this one right here. Kind of a craftsman style 2-story with a large attic like this one has. And I'm just amazed that you could do the whole thing for under $1,000. Shows where inflation has taken us. Our house was built in the house that we grew up in was built in 1917. So that's during the height of the effort, I think.
Well, I think we'll probably come back to this subject. It rhymes with Matt Spielman's talk about the housing market in general. But man, there's a bunch of these in the area in Royal Oak, Michigan, and Waterford, Michigan, and some of them are actually elaborate, approaching estate-style homes. It's just amazing to me, just amazing. And here's one for you, Matt, that just basically points out the long-term trend in the housing market. And there's a few people here on the webcast right now that are beginning to whisper "I told you so"s with that last bar on the right, for sure.
Well, and that's as we talk about the panic and everything going on, it might have escaped your notice, but the 30-year mortgage average rate, which was 7% on Thursday, and which was trending up to the point that people were spelling an end to the housing recovery, is now 6.5%, because that's tied to treasuries, and with the flight from risk, flight to safety in the last few days, it's moved that quite significantly. So that's arrived just in time for the spring selling season.
That's cool. That might actually be quite helpful to the economy in general. So I'm sure we'll come back to this subject also, but it's just it's a really neat thing. One of the places I know Matt checks out, I also have been checking out this Grit Capital. She's been doing a lot on the housing market, and just she's quite enchanted with this long-term trend that doesn't seem to be. Go ahead, Ken.
I should try to see, Mark, whether I can find the interview that was done on Bloomberg channel with the CEO of DR Horton.
Okay.
That's DHI is the ticker for it, where he indicated how short the time period was for people to get used to interest rates, no matter whether they were going up or going down. It didn't take years for people to get used to higher interest. It happened in a matter of months, and they've done academic studies over the last long period of time to show that once people are a little bit more used to the way it sounds on their ear and the way it trips off their tongue, it doesn't become nearly the roadblock to purchase as it does when it first goes up. Very, very insightful, as far as I was concerned, take on the idea that maybe normal interest rates, which we're kind of within that range of normal interest for housing, maybe those normal kinds of rates are going to eventually sound just right for the purchaser as we move forward.
Well,
I'll also make the point that in the last month, the millennial generation officially grew larger than the baby boomer generation. With the death and not death statistics moved the two generations so that the baby boomers, all of you that are out there listening to this right now, we are no longer in the greatest, largest generation that exists. Just keep that in mind as they tell you, "Hey, boomer."
and they will. All right.
And they will.
This is again just reduced to being a tease for next week. We do want to talk about international opportunities. Are they for real this time? And it's just interesting when you look at that chart, Ken. I think that qualifies as pretty close to a lost decade in international investing. And we'll take a closer look.
At least a lost half decade, 2018 to 2023. Yeah.
Yeah, it's there. So we'll be digging in on that in more detail. And last but not least, we're going to return to the Planet of the Apes for our game 2. Here's the result, Ken. Game 2 actually again goes to the 20 stocks picked completely at random over a 20-year period. I picked March 31st, 2020 because that was the bottom of the COVID period. So you're looking at a fairly ugly period in time for the S&P 500, checking in at 4.7%. And is that 4.7 or 4.9? I've got something in the way here. 4.7. The value line arithmetic average checking in at 9.9. And there are the 20 stocks chosen completely at random by a random number generator. Interesting that Simulations Plus made the list, Ken. And
Yes.
Interparfums too was another one of yours.
Yeah, I'm going to unmute one of our audience members that has their hand up.
Okay.
Let's see what Lila has to say. Lila, you'll have to unmute yourself. You're muted at your end, but as soon as you do that, you can speak to us. Okay, I'm going to assume that that's an inadvertent hand, and I'm going to take the hand down. Folks, you can raise your hand and ask us a question in real time. All you have to do is press that icon. If you look at the icon right now, that icon is showing a down hand. So if you want to raise the hand, just press it once. Go on, Mark.
Okay, so again, I just get kind of a kick at looking back over 20 years at this sampling of companies to see, some of the spectacular performers like Monster Beverage, which I probably never would have bought, but probably should go back and take another look at Celsius, current day situation. But just a whole bunch of companies there, and again, they add up to a healthy sum over that 20 years. And come in closer to the value line arithmetic average than the S&P 500. So again, the point that we're kind of trying to make here, there's the statistics that is out there that in 103 out of 103 situations, going back and looking at 20 years, money was made, positive returns in all 103 situations. So we'll come back and go for game 3 next time around. So let's go ahead and get to the fun stuff. No, that's not Ross Meredith on the left. But I just think it's wild. As an investor, I don't remember seeing anything quite like some of the confusion and the opportunity and the chaos that's going on right now. And I just thought that cartoon was kind of cute for those of you that are monopoly advocates. And the banker doesn't appear to always win, at least based on what we've seen here in the last few days.
I like the little conversation down in the corner, Mark.
This is my bonus tray.
Yeah.
And well capitalized.
Yeah.
All right. So you guys chime in as you see fit. I mean, this is just kind of the summary. Matt, would you like to kind of walk us through what you see as been going on at Silicon Valley? And again, Ross, feel free to chime in at any point.
Well, this is the very end of the story, right? And some of what will be interesting when we might talk about this in a couple of years is when was this inevitable, or maybe if not inevitable, when was it likely, and who knew about it? There are a number of commentators, including some of the ones posted in the forum, that talk about it being obvious as early as last November. And of course, the market can remain irrational longer than you necessarily can remain solvent. So who knows who bet against that? But later on in the deck, we'll look at the 2022 balance sheet, right, which was December 31st. But as we look here, where this story starts, importantly, is action by Moody's, and it is Moody's normal business process to notify a company when they're about to be, when I would assume when the rating's going to change. Nobody is sad that it's going to go upgrade, but that there was a downgrade coming. And so the company swung into action, worried that that in itself might cause, if not a run on the bank, some kind of misfortune, and looking for ways to avoid the downgrade. So that's where there's a little airplane under the line chart over March 2nd and 3rd, where they went not only to Moody's but also to their other ratings agencies to say, essentially, what could we do to reassure you and move on? Well, coming out of that conversation, and it's not certain whose idea it was, whether the ratings agencies even agreed or that this would change their mind or it's what you could do. Silicon Valley Bank filed for a stock offering of $2.25 billion because their shortfall was $1.8 billion. So they had, and think about that's probably about as big as you can do, because you never know if you're actually going to get that, what the market price is going to be. That was not a lot of additional breathing room for where they were. So how much was that really going to build? And then, as everyone knows, on Thursday the market reaction was there. You had one step down, one plunge, one because it was an after hours and things beget things. But then you also had, and this is not investor reaction, but depositor reaction to the idea that the bank needed to raise capital, and for all their virtues and foibles, one of the things VCs know about is raising capital and what drives companies to do that. So then you have Peter Thiel's picture in there, and there's pretty strict lines among the VCs about who thinks this was, I don't know, not a very nice move for, biting the hand that feeds you, maybe. Or not very nice to the community, and there's others that think that this is about survival. So there are a number of VCs who, in addition to giving you money, also give you advice or support, who called their companies and said, take your money out. Your money's at risk. As we talked about at the top of this hour, a lot of the companies that either IPO'd or had SPAC transactions in 2020, 2021, some of them didn't even have revenue, much less to say they're not profitable. So the bank prospered, in fact, almost quadrupled deposits from 2020 to 2022, largely for the proceeds of those transactions. And then what happened is they held deposits and they loaned the companies back money for things like, could be payroll, could be inventory, could be other operating costs. So those short-term costs were generally funded by loans against the assets they held. Now the company said too, there was another conversation about why in the world would such smart people have such a concentration of things? Well, there are, and I don't think anyone holds this opinion now because we see what happened. It's hindsight now, but there are some discussions that the company in prior analyst calls, so they'd go to a conference and talk about the business and say that they were well diversified, not because that they had a vast majority of their business with venture capital funded early stage money losing companies, but because they were in different industries. Well, yes. Oh, in San Francisco, by the way, in Silicon Valley. No. But some are biotechs, and some are software, and some are not software, AI and crypto, and
Right.
So I think you can always split up the pie and look diversified if your starting point is very small. But anyway, so those customers were fairly uniform in their needs, right? Because the other thing is too is then you look at, it's not only that they raised money, but you look at the last year they were not able to raise money with the raise of interest rates. You can see the IPO market dried up to near record lows. They didn't have an alternative source, so they started to have to live on that money all at the same time.
Right. I just think it's so cute that, especially with grandchildren, when you say stay calm, the exact opposite happens. I guess, Russ, I have kind of a question. In your summary, you talked about this chart on the upper right actually brings into fairly stark relief how rapid the the Fed has raised interest rates by this red line that we see here. And although that's part of the causation, I think here, you basically fairly held the belief that that's not where all the problem lies. Could you elaborate on, how you see the rapid increase in interest rates and, what Silicon Valley did, and just what did you think about all that?
Oh, absolutely. I hope there aren't too many people in the audience that are either bankers or examiners, because they might not be too happy with my opinions. But I think the greatest problem was bank management's acquisition of as many deposits and bonds as it did in such a short time,
Mm-hmm.
under the conditions that they did so, without managing the exposure that resulted from those acquisitions being closely tied to the same things. So what I mean by that is first of all, Silicon Valley Bank has a parent that owns a venture capital company, a private equity company, and a brokerage. So its ties to the venture capital industry or group is pretty close. A lot of those venture capital types had gotten loans from the bank. I think half of Silicon Valley's loan portfolio was to venture capitalists. And of course, it would be natural for those venture capitalists to recommend that their clients, their startups, bank with Silicon Valley. So when the money began to really flow rapidly, when the Fed was increasing liquidity in the market, in 20 and 21 particularly, a lot of those startups found it real easy to raise capital and acquire a pretty good stake. They promptly deposited that money into the bank with the sort of expectation that there would follow additional capital raises and or additional stock sales. The bank, in other words, required so many of these deposits so fast over that 3-year period. I mean, it tripled its balance sheet in 3 years. And those things are all tied together. The loans in the bank was not the problem, but because those deposits came in so quickly and they found themselves flooded with cash, they couldn't deploy it fast enough as loans. So they dumped it into bonds. Initially, a lot of those bonds were really low rate ones. And this I fault management for. The average duration of the whole bond portfolio was 3.6 years. So when rates began to rise, those things depreciated. So you had a confluence, a very unusual situation where the bank's balance sheet was susceptible to the effects of rising rates, both on the asset side in the bonds and on the liability side, those deposits from the startups. The rise in rates made the cost of capital more expensive and made it much more difficult for those startups to obtain additional funding. And so they began drawing down those deposits faster than perhaps usual. Perhaps, I'm sure it's faster than the bank expected.
Absolutely. Yeah.
Russ, a question. I'm not sure if you're familiar with this angle. One of the longer term issues that you could talk about for management behavior was that Silicon Valley Bank's CEO lobbied pretty hard to raise the deposit requirement to be systemically important, too big to fail. So they weren't subject, or were no longer subject to stress tests or living will, that sort of thing. But in this scenario, do you know if the stress tests that are part of Dodd-Frank and all that cover a scenario of interest rate risk like this, or is it all, were we all fighting the last war and it's all about a strong recession or other issues this wouldn't handle?
You know, when they originated stress tests, the whole idea was to calculate interest rate risk. Though I think the stress tests are kind of backward looking. So the growth rate of this bank was so fast that stress tests probably did not reveal the real risk that had accumulated even during the period the stress test was being done. And quite frankly, I've never really had a whole lot of faith in stress tests anyway. They're pretty much fantasies. You know, you conceive of a future in which certain conditions occur, rates rise so much, and what happens to your income if it does. That's kind of a thing that, some banks, more diversified banks, is going to be a little easier for them to do it. But in this bank's case, that was kind of hard to detect. I don't think the stress test was really the answer.
Well, Ross, is there some element of just pure human stubbornness here with the 5-year plus bonds that they were buying? Were they, because again, I've read a number of experts who basically say under the conditions we've had for the last 6 or 9 months, you basically should have been paring down and reducing duration on your bond portfolio. And these guys seem to be pretty stubborn about it. Is that a fair way to think about it?
I'm not sure what they were thinking, if they were thinking. So most all banks most all boards of directors, and I'm sure most certainly bank boards of directors, have a committee called an ALCO committee, ALCO, and that stands for Asset Liability Committee.
Mm-hmm.
That committee's job is to monitor rate sensitivity and the balance of maturities on assets and liabilities. In this case, you had to know, I'm sure the bank had to know, that when those deposits came in from those startups, they were all demand deposits. There was no time deposits among them very much at all. And it had to be a situation they understood where those those funds would not be really stable. They were going to be going in and out at sometimes a rapid rate because, for one thing, all those deposits were way up there in size. I think guessing the average size was somewhere around 3 million, which is comfortably above the insured part.
Mm-hmm.
These are not typical mom and pop deposits that don't move much and tend to be very stable. The bank had to know that.
Well, how closely does a bank like this monitor burn rates? Call it a composite burn rate or something on that order, Ross.
See, I really don't know. I think if you're in that business and your customer groups are that largely represented, you had to be doing something to follow that. I mean, I would expect it. So I'm apologize. I'm starting to sound like a bank examiner now.
That's all right.
That's the way I tend to think. But I would have held management very much accountable for not being more aware of that situation and not having done something about it at the very outset of 2022 when rates began to rise. I don't understand why it didn't set off some really big alarms.
Ross, we have a question from Nick, and he'd like to know, is there an average duration for a healthy bank's portfolio of treasuries? Is there some kind of a standard? He seems to think that 3.5 years is rather conservative.
We've got a slide that's going to show that, Ross.
The quick answer to that is, yeah, it is fairly conservative. The more complicated answer involves a couple of things. Number one, regulators require banks to keep a certain amount of assets, very short-term and liquid, as a bulwark against unexpected deposit declines. So there are usually, in accounting, there's 2 ways to account for a portfolio of securities on the bank's balance sheet, investments, right? And banks are limited in what kind of things they can invest in. They have to be very safe. Municipal bonds, national government bonds, most of them stick to government bonds. So the category that is required for liquidity purposes is called securities held available for sale. And those things are marked to market on a quarterly basis. So, if you have some, say, 1-year-old or 2-year duration things in that pool, which is unlikely, it's supposed to be real short-term stuff. Nevertheless, when rates rise, even 1-year maturity bonds are going to decline in that situation. The balance of those bonds is in a held to maturity portfolio where there is no mark to market situation. So that depreciation accumulates over time. That depreciation, by the way, was recorded and reported in SEC reports and in call reports to the FDIC. So the information was there. People could have noticed that. And
Yeah,
that number got to be pretty big. As of 12/31/22, they I think had 93 billion in the held to maturity portfolio, and it had a value of about 75 billion.
and that had actually continued to drop even further.
Correct.
And it was a deterioration at the end of 2021. It actually showed that they were net positive. It was a mark, or no, well, close. It was 97 versus 98. So that all happened in 1 year.
So
Right.
this
That's
kind of goes to Ken's original question at the start of the session about what was out there in full view. And this is kind of one of them. And Matt shared this on the forum. It actually shows the current fair value of those bonds that Ross was just talking about. So you're looking at a deficit which was growing rapidly. And then to give further context, in 1 day, 42 billion was withdrawn.
Yeah.
You see the numbers right here, guys.
So,
Boom.
so there are rather stringent rules. You know what? There are rather stringent banking rules that say that when a bank's capital level reaches a certain percent, it's usually 1% of assets. That's the same thing as insolvency, especially depending on how the trends are going. So the bank was declared insolvent, even though there was a little bit of equity left.
Okay, I have a comment on this, guys. In my research, I came across a comment that Silicon Valley Bank did not have a risk officer in the recent time frame.
Yeah, I think Ross mentioned that.
Yeah, they, as a matter of fact, they had a risk officer until about April, I think, of 22, and then I don't know whether she quit or they set her aside. But between April of 22 and year end 22, the ALCO committee had 18 meetings. Now, normally an ALCO committee in a stable situation would meet maybe 4 or 5 times a year. So they were busy talking, but I don't know exactly what those circumstances were. It was a little strange that the risk officer would suddenly depart in April or be set aside in April. She didn't leave until October. So they kept her around for 6 months. They just simply wouldn't, they took away her authority.
Mark, could you explain on the slide that's on the screen right now the significance of the blue dots and the green dots on the graph?
Yeah, and in fact, I'll turn it over to Matt, but this was part of my primary driver for investing in Western Alliance yesterday morning. I think it's pretty clear to see that, just looking at this, even if you didn't know what it was about, that this one down here is different.
Mm-hmm.
And Western Alliance is actually one of the better looking ones. It's better for the dots, the yellowish dots, to be closer to their overall capital. And so, Matt, would you like to elaborate on?
Yeah, that's basically it. And for the audience, apologies that this is kind of a mismatch of styles, even to say, but we're getting these from a number of different sources. So that's why I've always tried, when I've copied and pasted, I'm trying to cite the source too, in case there's reason to go back. But the chart on the right came from a JP Morgan note, an analyst note that came out Monday that I thought is one of a number of good sort of overviews of the situation. So the blue dots, and you can see the label up there, Common Equity Tier 1 Capital Ratio. So that's, now they're doing it not in absolute numbers, but ratios, because these banks are wildly different sizes, right? It includes JP Morgan itself, Citibank, Bank of America, and a bunch of regional banks. So they went to percentage to get on the same sort of scale, but it's the capital is reported. And Ross talked about, when we were looking at the last page on the balance sheet, reported versus that accumulated. Now you could have a gain, right? If interest rates go down again, and they're still buying notes now, that may turn into a gain and those dots go up. But in terms of where we are now, universally, there is an unrealized loss on those securities that are marked as held to maturity. And so the first thing you don't want is you don't want the green dots to get down to 0%, right? That's what happened to Silicon Valley. That's essentially insolvent. But if you're looking at one measure of a bank's quality, or one measure of their effective risk management, so that they don't have a large unrealized loss, then you want the dots to be closer. You want the dots to be high, first of all. That means they have a lot of equity for the capital they have. And you want them to be close together, means that relative to the reported capital, there's not a large unrealized loss. And so generally higher is better, and generally higher green dots in particular are better relative to the blue.
So, Matt, I'm going to further ask some questions for our audience here, okay? If I was looking at the right side of the chart here, which essentially is dealing with regional banks rather than money center banks, I would tell myself that Western Alliance, for example, is probably better positioned than the bank on either side of it on that graph.
Yes, yeah, looking at those directly, I don't, Mark, if you want to, yeah, well, you have the underneath there. I have my questions underneath. Yeah. Western Alliance is, it's considered, certainly relatively high. It's still to the right, but that's a fairly flat line once you start, let's say, past Wells Fargo, right? You're getting into smaller banks too. So as a pure comparison, exactly right. They have less unrealized losses compared to the total capital they have compared to those two peers.
So I looked at this, and this one of the things that I think sets Western Alliance apart. I mean, I've looked at the bank fairly carefully, and it kind of going to Nick's earlier question. This kind of shows you a distribution of those maturity ranges for a bunch of banks. Notice that the current problem spot is up at the top there, and you got to go quite a ways down to get to Western Alliance. So,
yeah, and one comment maybe back to Nick's question, or maybe to pose to Ross, is another way to say when you're talking about, it was simply that 3.5 years is wrong, right? The goal of the bank would generally be to match the duration of liabilities with the duration of their deposits, right? And so I think Silicon Valley was an extreme example because they had essentially all short-term deposits, but were trying to reach for yield. I saw somewhere that they were paying north of 5% on some of their interest-bearing deposits without doing something else. But if you look at that long list, and it's kind of an eye chart, but number 4 is Bank of America. Bank of America has almost 28% in long-term duration items, but of course, Bank of America does a lot of mortgages. So you would expect that they would have more or higher compared to the whole chart, long-term loans, which really are the mortgages themselves versus the assets too.
We're getting questions from our audience about what about other banks, and we have to understand that this graphic is taken from a report done by, you said JP Morgan, right, Matt?
The one on the right, correct. The one on the left.
And that's a selected group from the JP Morgan selected. If you're going to want to deal with your own bank, I guess it's going to take some digging to try to find these numbers in their numbers to be able to add it to the chart. How difficult would it be to find some of those numbers, Matt?
Well, as a ratio, can we go back to the balance sheet? So it is right there. This is the 2022 balance sheet for Silicon Valley Bank taken out of their 10K. It's noted, it's usually bookmarked, so you can go to it right there. This is a crude way. Some people say, well, if you're going to take your equity, the bottom number, you should take out preferred stock. But we're talking more from the bank seizing or closure versus just the standpoint of a common stock investor. If you're looking at an investor, that 16004, you might actually want to subtract the 3646 and say, when am I out? I don't care if the bank survives. I want my investment to be safe. Mm-hmm. But essentially, it's all there. So in their assets, they will have, and again, the assets are the debt they buy, or for a mortgage, make the loans they have. They show held to maturity. It says on the left. So Ross mentioned there's available for sale, which are marked to market directly, and there's held for maturity, which may accumulate this either deficit or value. So the first step is to compare those two and see if there is actually a deficit. Again, that number, which here is 76,169, could be more. If we have a sustained or fast amount of interest rate cuts for some reason, that will easily go up. So you compare the net of those two as reported versus what is the fair value. The declining deposits is really just a comment. That's not part of the conversation, but then you simply go to the bottom and look at shareholders' equity and see what's there. I won't compare this calculation directly. Like I said, it's crude to JP Morgan's value, but if you're looking, for example, if you're doing an industry study and you want to compare a number of peers, you could start just at that simple level and see if anyone sticks out.
So I could enlarge on the whole concept of rate sensitivity a little bit, if you like. What the goal of the ALCO committee is to match maturities of the assets against maturities of liabilities, which is deposits. In SVB's case, there was no maturity for the vast majority of those deposits brought in by the startups. Those were all kind of basically checking accounts and largely uninsured. So there was no real predictability to matching the volatility of those. So you really couldn't pick particular bonds on the asset side beyond, a much longer maturity than about 3 to 6 months, unless you were really interested in taking a tad more risk and making a few more dollars, in my opinion. See?
Yeah, this number here was quite a bump up. That's some of that cash flowing in that you were talking about, that 125.
Correct.
And yeah, with perfect hindsight, I think we can look back and say, well, they should have been happy with 1 or 2% interest on that.
Right. Yeah, it was another mistake was offering 5. Maybe it's a sweetheart deal or something else, but yeah, they should have been in a money market themselves or something that liquid.
Right.
Good stuff. All right, so we'll come back to that one. A little snarky slide. One of the things that I was looking at when I sat down to think about, do I invest into this mess, do some bottom fishing, I pulled up the numbers that we have a lot of trust in, and it goes right back to return on assets. I grabbed a list of regional banks and ranked them by return on assets, and then you would proceed to dig in and do some of the stuff that Matt was just talking about. But pretty interesting looking list. When you start looking at those return on assets, those are all pretty good numbers. You, of course, want to, as Ken counsels, you want to make sure that that's an established track record and not a one-time thing. But in these cases, those are snapshots. And it's a pretty decent place to go thinking about buying into one of these situations if you want to take on a little bit of this, and I'm using air quotes again, regional bank risk. And so I'm looking down at Western Alliance and, just all the stuff that Ken has taught me and all the stuff that we've done. I mean, there's some things in here that might be pumping that number up a little bit, but you start looking at these numbers all the way across here, and I couldn't resist. And it basically sunk in a couple handfuls of Mark and Wendy dollars, somewhere pretty close to that number. $9. I know there are people that posted in the manifest forum that they got in at between $8 and $9. So that's pretty cool. Not cool if you're already a shareholder, but
and we should make it extremely clear that this is mad money that's being used. This is not investing, folks. This is this is speculating, and it's drawing some conclusions from data that might be extremely reliable, but then again, it might be sending us into a swamp like your GPS occasionally does. So we got to be really careful when we're showing people information like this.
Absolutely. Go ahead, Matt.
Okay. To foreshadow a future session, it's one of I have my research down to my top 150 Joe Tillinghast quotes, so I have to narrow that down a little bit more. But one of the things he says is any time you're betting on a particular occurrence, and he does not specify the duration of that, it's speculation. That investment is specifically time indefinite. That you will have good times and bad times that go down, but anytime that you have a time frame, whether it's today, whether it's interest rates for the rest of the year, something like that. It's speculation to one degree or another.
Absolutely. And I treated this completely as a special situation for my personal investing. It was in my play money account for special situations. And I basically wanted to come back and take a look at the tangible book value of the company. The quickest definition of the tangible book value is the theoretical amount, if the company goes bankrupt, what it might be worth on the wrecking, after it's been demolished by the wrecking ball or the cutting room floor. What might it be worth? And so I actually set that as my sell limit for the shares that I bought at $8 or $9. I had no idea it would reach it by lunchtime. which is what happened. And again, some of the stuff that I'm digging into on this company, again, we know this company fairly well. I think we might be overestimating the growth a little bit based on these numbers down here. That's up for anybody in the audience to take a look at. But whether it's 12% or 15% or whatever, it's still a rapidly growing bank that has shown all the signs of being relatively well managed. So this is something you want to keep track of. Discovered that Citadel, that's Ken Griffin's company, one of the best performing hedge funds, came in at 38% last year during a down year for the market. They're buying it hand over fist. So here's a closer look at that whole situation, looking at the tangible book value. Another way of looking at some of that same information, I left return on assets on here, but this is from today. The price had already shot up on Western Alliance up to the mid-20s in less than a day. And what I wanted to take a look at was, companies that have a price to tangible book value, and maybe do some shopping on this list. Lo and behold, one of our best small companies for this year is on the list now. And First Foundation, that was asked about earlier, is on this list of, again, you want to put it through all the tests, demand quality. By the way, the comments about the manifest quality not matching it, I think it is a matter of, it's obscured by the fact that they're buying these 5-year and longer government bonds, which are basically defined as zero risk, very, very high quality. So I would make a direct comparison to the tranche myth that happened 15 years ago. But it is a specific situation to SVB, Silicon Valley Bank, that great investments, wrong time, wrong application is what it comes down to. And they really screwed it up. But when you're looking at the collection of assets that they have, those are extremely high quality from an investment or financial standpoint. So some good clean fund there.
As a bondholder, they're not going to be defaulted on.
Exactly. And they're not a problem if they're held to maturity. You get all your money back at maturity. And that was not
maybe
happening.
one thing too, and I know we're at time or close to time, but there's a lot of questions again. As First Foundation comes up now, or with a focus on it, Ross, maybe if we can take 30 seconds for investing as opposed to speculation, can you quickly go over the bands that you've talked about in terms of return on assets and what sets out quality banks?
Yeah, it kind of fluctuates a little bit from time to time, but generally below 1% is kind of average to below average. 1 to 1.25% is pretty good. 1.25 to 1.5 is very good. Anything over 1.5 is good. Very good.
So as I'm looking down that list, my eye is going to be drawn to the 1.4s, the 1.6s, the 1.9s, and the 2, and I'm going to study those banks to see if they're behaving better, and there may be opportunity there.
And when you're doing an SSG on banks, that is one of the columns in section 2, or one of the rows in section 1 actually. So you can even chart it and see if it's consistent. Or I'm sorry, it's section 2. It is evaluate management. But you can see not only how it is in the last 12 months, say, but how it's trending.
And the long, from my point of view, the longer the trend has stayed above a certain benchmark, the better off probably I am in looking at reliability of that number then.
Okay.
One characteristic I don't hear you discussing, Mark, is the yield. At $9 a share, Western Alliance's dividends were like 6%.
Yeah. I mean, obviously, if those dividends are safe, and they very well could be, that's a monstrous.
Another criteria.
Yeah, it's a good point. All right, and then the ultimate thing, which actually pushed me over the edge to doing this, happened Sunday night, and this is part of what Ross talked about in his post. The feds came in, and we just talked about how if you hold a bond to maturity, you don't have a problem. You don't have a write down. So Ken is.
There's that word again, Mark. Okay.
Well, it came back, Ken. It's right here.
Okay, I know. I see it.
Sorry, Ross. That's from actually a few sessions ago when we fought over that word cotier. What they basically did is they came in with all these banks, and for the depositors, they basically said you don't have a problem anymore. So all of the turbulence in this, well, not all of it, but certainly a big piece of it, was addressed by this situation. Now, there's going to be a lot of people that don't care for this, but you basically have a situation where the largest component of the calamity was completely suppressed. That's one of the other reasons I bought the stock, and it's actually pretty wild. And
yeah, it certainly is, and how things unfolded, with Monday being even more pessimistic after those actions.
Exactly. So.
Should we make the point, Mark, that the funding to make these people whole is not coming from the Treasury or the taxpayer? It's coming from an insurance fund that the banks fund themselves?
Yeah, Ross, you might comment on that. It's from the FDIC, and how does it basically work? How is that funded?
The bank, the FDIC charges banks a certain percentage of their deposits as an insurance premium. So they pay a fee to the FDIC in order for that insurance to have that insurance. The fund that the FDIC has built up is essentially an insurance company's reserve against losses.
Mm-hmm.
And that's apparently what they're going to use to cover losses beyond everything they've even charged for.
I haven't looked, Ross, but
wait, Mark, can I get in there? Going forward, Ross, does that mean that there's going to be larger expenses on the expense side of running a bank? Because if they're going to make these people whole, that insurance is going to have to move up. That just seems logical to me. Am I reading that correctly, or is this a fund that's so large that it can absorb these losses with no problem?
No, I think, well, yes and no. In past periods when there's been large numbers of bank failures, the rate has tended to go up. It's kind of like any other insurance company dealing with calamities in weather and other factors.
So it's based on an actuary sitting down and deciding what the rate should be depending on what the action has been in that insurance?
Yeah, hopefully it's that clean and simple, but I'm sure there's political issues involved too.
Okay, all right, fair.
Yep, a lot of good stuff there. All right, and the picture on the upper right is actually a tribute to my late father. He used to agonize over the use of nail guns in building roofs, and this is why. He said, because if you're driving them with your hand and a hammer, you know whether or not you're striking that beam underneath. So there you go, Dad. I didn't miss that lesson. And then I just got to love this one on the heels of the Academy Awards on Sunday night. That one fits too, from our acquaintance Ben Carlson at Ritholtz.
Okay.
Everything, everywhere, all at once. And if you're right, Ross, we've got to raise the premiums. I don't think there's any doubt. All right. And by the way, this is
We're-
by the freaking dip. Some people.
We're also getting that same comment, Mark, from a number of folks in the audience that there's a Wall Street Journal article out that indicates that if this should go to its logical conclusion, that fund is not nearly large enough to cover everything.
Yeah, I was afraid to ask that question.
Yeah.
All right. So let's go ahead and kind of wrap things up. If we've got other questions, we can come back to this topic. I think it's a fascinating topic. I have never bought a company before lunch and sold it at lunchtime in my life. So please don't believe that I do a whole bunch of that. So we can handle that with Q&A. Here's a reminder that we do archive all of these sessions on YouTube. Just go to Manifest Investing and search for it. Please subscribe if you find the content useful, but we'll let you know anytime new content is added. We're not going to go over this now, but we did actually dip below $1 million on our best small company portfolio yesterday. And the presence of Service First Bancorp, which is highly ranked on that list, as is Metropolitan Bank, they both put a dent in us, but we hope it's transitory. At least transitory. Okay. Just a quick reminder that Ken and I will be in Troy, Michigan a week from today for a session with the American Association of Investors, individual investors, and we'll have some fun with those guys just talking about some pretty cool stuff. I suspect we might answer some bank questions also, Ken.
Wait, I'm going to bring some waiters along, Mark, okay?
All right. And then just the tease. Now, Matt, are you still looking good for next week? And Ken, do you think we could pull this off and make it to the American Association next week?
I'm wondering if we should maybe give ourselves an extra week in here about this book, Mark.
What are your thoughts, Matt?
Yeah, that's fine. I mean, obviously, as I said, I had sort of Joel's part at least corralled, if not done. I've done something else in the last week other than really get Annie's in shape, so I'm fine with that too.
Okay, so maybe we will defer it until maybe we'll do some teasing type material next week, but we'll cover the full book report. It's a dual book report of these two books. If you're not familiar, you want to pick them up. I have finished Big Money, Think Small. Loved it. Absolutely loved it. All right. And with that, we'll sign off with a picture of the Chicago River. I think they did this on Sunday. They didn't wait for St. Patrick's Day. And I used to see that every year. So with that, Ken, we can stick around for some questions. I think I'll go ahead and shut down.
It looks like the Cuyahoga River looked when I was growing up, Mark. I don't know what's...
Well, your river was on fire.
Well, no, it was that color before it caught on fire.
Good stuff. Well, as we sign off, I want to thank Len Douglas, Matt Spielman, and Ross Meredith for joining us. Thank you so much, gentlemen. Your contributions are massive.
Ross,
thanks, Ross, very much.
Big thanks to Ross. Ross, the great session today. Great session.
Thank you very much, guys. I hope I didn't wear out my welcome.
No, you didn't. Not at all. You're always welcome. All right. And with that, thank you, Ken. And hopefully our lives will calm down a little bit. We got a little bit of work to do before next Tuesday. So got to find time.
I'm going to travel down to Grand Blanc tonight, Mark, and face the B.I. Baker Model Club that owns Western Alliance. And after they finish throwing things at me, and we'll have to see where we go with it then. All right.
Well, if you need reinforcements, give me a call and I'll come up and we can double team those guys.
Double team them. Okay. Good night, everybody.
With that, take care, everybody, and we'll be back next week.